Guys, we need to have a conversation about leverage ETFs, the potentials and the risks of leverage ETFs, and whether you could transform $1,000 into $1,000,000 by using leverage ETFs. If I ask you, like, hey, do you want to invest $1,000 and 20 years later, this can be $1 million and make a big difference in your retirement, would you invest $1,000? Would you invest 1% of your wealth into leverage ETFs, 10%, 20%? Personally, I have around one third of my portfolio, around 33% into leverage ETFs. Is that crazy? Or am I taking a calculated bet with calculated risks? This is what I want to tell you in this video. What are the potentials and the risks of leverage ETFs and whether you should have it as part of a long-term portfolio? By the way, this is not financial advice. Do your own due diligence. There is no one size fits all when it comes to investing. So really, you need to understand your risk profile and your investment goals and whether you need the money in the short term or not. But without further ado, let's get straight into this video. And I'm going to tell you how to transform $1,000 into $1,000,000, the leverage ETF strategy that nobody talks about. And I'm going to be debunking leverage ETFs myths and strategies and the risk mindset to shift to financial freedom. And why am I doing this video? Well, I've been investing in leverage ETFs now for like 5 years or so. I have read every single book about leverage ETF. I read all the blog posts. I listened to tens of hours of YouTube videos talking about leverage ETFs. I read all the papers. I did hundreds and hundreds of back testings, and I created the first course ever about leverage ETFs. I'm writing a book about leverage ETFs. I want to write a paper about leverage ETFs. You are probably looking at top 0.001% of leverage ETF specialists in the world. Not to brag too much. The goal is not to brag, but that's the reality. I've spent thousands of hours investigating and testing and researching about leverage ETFs. And that's why I invest with confidence into leverage ETFs. I don't want you to invest in leverage ETFs if you don't have experience in investing in regular ETFs, because you will make mistakes. But hopefully this video will put you a little bit closer to making generational wealth by investing in leverage ETFs. So what if you could turn $1,000 into $1,000,000? Most people will avoid leverage ETFs due to fear and misunderstanding. Because if you simply Google search about leverage ETFs, you will see like, oh my God, that's rat poison and it's not suitable for long-term investing, which is wrong. Those people that say that never did the math. So probably these misunderstood investment vehicles, the leverage ETFs, can put you in your path to financial freedom. There is actually a strategy that is outlined in this book by P.D. Collins, 1,000 to $1,000,000, that outlines how to basically transform $1,000 into $1,000,000, and it's all back tested. It's actually very similar to other strategies that I developed, and I was very happy to read this book because it basically validates the strategies that I've been doing already for a few years. And really, I'm not the first person saying that you can invest in leverage ETFs for the long term. But a little background on leverage ETFs. What is an ETF? ETF stands for Exchange Traded Fund and is a pre-packed investment basket. It's a basket, in this case, of stocks. You have, for example, S&P 500 ETFs, which basically have 500 companies, the 500 companies in the S&P 500 index, which are the 500 biggest companies in the US. Or you have the NASDAQ 100 ETFs, like the QQQ, which contains 100 companies. You have their Amazon, Meta, Nvidia, Tesla, all these companies, right? And because they invest in many, many companies, these ETFs are fairly diversified, right? S&P 500 invest in 500 companies, 500 biggest companies. Half of their revenue comes from many, many countries around the world. So it's pretty diversified. And when you buy an ETF, you are basically buying these hundreds of companies. Okay, but these are simple ETFs, right? What about leverage ETFs? Well, leverage ETFs will amplify the index daily returns, okay? So leverage ETFs like TQQQ will amplify the index daily returns by 3x. So if NASDAQ goes up 1%, QQQ will gain 3%. But it works both ways, right? There is a 1% drop, QQQ will drop 3%. So you need to have that into account. But the reality is that when you look at the charts in the long term, Nasdaq, S&P 500 always go up. And I believe that the American market, the American stock market, is the best in the world. I will not invest in leverage ETFs in any other index in the world for many different reasons. You should probably read the book Why Nations Fail, that shows like why some countries succeed and others don't succeed. US is not perfect, but when it comes to the stock market, I trust that the stock market will continue going up. And that's why I invest in leverage ETFs for the US stock market only, mainly S&P 500 and Nasdaq leveraged ETFs. But what can you get with these ETFs? Well, let's take a look at this chart. So here you have QQQ, which is the normal Nasdaq index, and the triple Q. And this chart goes back 14 years, okay, 14 years. So if you have invested in the normal Nasdaq, you'll have a return of 899%, 900%. You basically 10x your investment. Not bad, right? But if you have invested in the triple Q, which is 3x the S&P 500 daily returns, you'll have 12,000% return. This is absolutely amazing. And I'm okay taking a little bit additional risk in order to have such an outsized, potentially outside investment return. This is a very asymmetric bet because, yes, leverage ETFs, as you can see here, yeah, they are volatile. They can go down 50%, 60, 70, 80%. In fact, during the market downturn of 2022, my leverage ETFs went down like 70%. But now they are rewarding me very, very well, very handsomely. It's my best performing investment. So, are you willing to take some volatility in order to get potentially like a 12,000% return over a period of 14 years? Yes, I'm willing to take some risk and I'm willing to take some money into this and risk, okay? There are many papers that back this. In this paper, it shows that the 3x leverage cumulative return since 1928 is an astonishing 681 times of that of the unleveraged S&P 500. So you can see here the returns of $1 invested into the S&P 500 or S&P 500 leverage 1.25, 2x, and 3x from a period from 1928 until 2020. So this is a very long period, 92 years, right? But what's really outstanding is to see that 2x will return not 2 times the S&P 500 during this period, but 146 times. And if you have invested on a 3x leverage ETF during this period, it will return not 3x, but 681 times. It's absolutely crazy. And it shows the power of compounding with leverage ETFs, okay? And many people will tell you, oh my God, leverage ETFs have like this decay, the volatility decay or time decay, because when it goes down 50%, right, anything that goes down 50% to go up to the same level, it needs to recover 100%, right? Or if it goes down 10%, not to go to the same level, it needs to go up approximately 11%. That's how volatility decay works. But in the long term, as you can see here, it doesn't seem like this volatility decay will affect negatively the ETFs, right? If you are not doing a little bit of leverage, you are leaving gains on the table. So it reads here that the idea that leverage is only suitable for short-term trading is false when looking at how daily leverage can perform over the long-term cycles. In fact, short-term investing, short-term trading, 95% of the traders lose money, right? You look at all the data, the 150 years data of stock market investing, and you know that in 95% of the 10-year periods in the stock market were positive, okay? So if you are a long-term investor, you have like 95% probability of making money, including with leverage ETFs. But if you are a short-term trader, you know that you have 95% probability of losing money. 95% of the day traders and short-term traders lose money. So why not investing in the long term? Just set and forget. People can allocate a little bit of their portfolio into leverage ETFs and check them again 10 years later. And most likely 95% probability, you'll be very happy with your investment. And these leverage ETFs can really compound very fast and can transform $1,000 into $1 million, right? Okay. Oh, what about the volatility? Yes, there is volatility. So as I was showing you before, actually from the top to the bottom, Triple Q, which is the 3X NASDAQ ETF, dropped by 80%. Okay. So while the normal NASDAQ declined by 35%, the Triple Q declined by 80%. Oh my God, that hurts, right? But you are a long-term investor. And eventually, if you didn't do anything, 2 years later, your investment will be fully recovered. So it just really doesn't make sense to panic when the market goes down. Actually, when the market goes down, I kept buying, 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 buying. I will show you in a few minutes this investment strategy. And it will return very, very handsomely if you are using DCA, dollar cost averaging, to invest into leverage ETFs. So meaning you can put a little bit of money, a little bit of your savings every month. Let's say my strategy used to be I receive my salary. Let's say I can save $1,000 every month. $100 or $200 go directly to leverage ETFs. Okay, you don't put all your money into leverage ETFs. Okay, because it will hurt very, very badly if it declines by 80%. But you can put, depending on your risk appetite, you can put 5% of your savings, 10%. Of course, you need to assess again your investment risk profile. This is not financial advice. Each person is different. But if you have the ability to put 1, 2, 3, 4, 5%, I put 30% of my wealth into leverage ETFs, you can start understanding like potential of these ETFs. So yes, as you can see here, it declined by 80%, but even when it declined by 80% at the lowest point, Triple Q's return for the 14-year period remained at 2,300%, while QQQ, the normal NASDAQ ETF, returned only 338%. So if you look at the bottom of the market, when the market in 2022 went decline like this, the Triple Q still had a way better return, 2,300% versus the 300% only of the non-leveraged version, okay? So even with the huge decline, Triple Q will be way better in this 14-year period than the normal NASDAQ. So yes, I'm willing to take this bet. I'm willing to take a little bit of the risk to get these amazing returns. And yes, there is volatility, but honestly, volatility is the price of performance. Do you know any investment in the world that performs very well, amazing returns, and very, very low risk? No volatility? I don't know anything like that. And if there is someone telling you that there is an amazing investment that returns amazing returns and the risk is very low, probably it's a scam. Don't fall for it. So, yes, the investment that I'm telling you now, there is very high volatility, a lot of ups and downs. But long-term investors don't care about volatility. Do you think that Warren Buffett is looking at the portfolio on a daily basis and saying, "Oh my God, the market is crashing"? No, he doesn't care, right? Actually, he will look at market crashes and market downturns as opportunities to buy more, to invest more actively. And this is what you need to do. Be fearful when everyone is greedy, be greedy when everyone is fearful. Okay, so volatility, let me get that out of the way. Volatility plus short term equals risk, but volatility plus long term equals performance. Okay, so yes, investing in a volatile investment like leverage ETFs in the long term equals performance, like we saw in the previous charts. Drawdowns and periods of market crashes should be seen as discount opportunities, times to buy cheap rather than reason to panic. This is a very important factor to transform $1,000 into a million. So I not only use a DCA strategy where I buy a little bit every month, but when there is a market downturn like 2022, the market was bear market, I buy even more aggressively because I'm buying it cheaper. The market will recover and the returns will be even better. So yes, if you Google search, you'll find a lots of headlines like these. Don't buy and hold leverage ETFs. Leverage ETFs are a bad idea. Why triple leverage ETFs like Triple Q aren't designed for long term? But the reality is that none of these articles, none of these people did the math and did the back testing. If you do the math, you do the back testing, and this is what I have done in my first ever leverage ETF course. I will leave the link in the description of the video. I did a 4.5 hours course explaining exactly how leverage ETFs work, all the math behind it, all the back testing, and how to manage these investments because it can really be life changing. Now, the question is, do you have the stomach to stick to the strategy when the market drops? Yes, because it will be volatile. But if the answer is yes, you have the stomach to look at your portfolio declining 20, 30, 40, 50% and do nothing, then you will be very well rewarded, like we saw here, right? Imagine you invest in a triple Q 14 years ago, and there will be a period that we'll see your investment crashing by 80%. If you did nothing, look at this. You are doing amazing. Okay. So, yes, if you do that, you'll have amazing investment returns. So, the 80/20 strategy that is outlined in the book by B.D. Collins, okay, this book here. I don't have any affiliation with him. I'm just showing you the book because I quite enjoyed this book. And I even have like lots of highlights here in the book. I highlighted everywhere, and it's very funny to see that the because I use a green marker, right, and I'm using a green screen on the video. If I show you the highlights, it's like transparent. Okay, anyway, so according to Collins, if you have invested $1,000 20 years ago and added $250 quarterly only using this strategy, you'll now have over $1 million. Okay, and you will add to your leverage ETF portfolio depending on how much the market dropped, right? I detail all these strategies in my course, but basically, let's say, imagine the market drops by 20%, you allocate part of your cash into it. If it drops 20% more, you allocate more of your cash. If it drops 20% more, you allocate even more. And then when the market recovers, you'll be very, very happy that you did that. Never sell when the market is crashing because no one can time the market. No one knows if the crash is going to happen or not happen. No one knows. No one in the world knows. That's why even Wall Street fund managers, professional fund managers, they are paid multi-million-dollar salaries. They have all the Ivy League university top graduates. They have multi-million-dollar AIs and algorithms and computer infrastructure, and they still underperform the S&P 500. 80% of the Wall Street managers underperform the S&P 500. So who am I, or who are you to say, I know when the market is going to crash, I know when it's going up? Forget. No one knows. So the best is to have a strategy that is automated. And when the market drops, you buy a little bit more, and you can buy a little bit more because you know that the market will recover and you'll be doing very well. So how to allocate to your leverage ETF portfolio? So instead of going all in on leverage ETFs, I don't recommend doing that. You can allocate a small percentage, especially if you are young, okay? If you are young like me, I'm 18 years old. No, just kidding. I'm a bit older. Depending on your age, if you are under 30, you can put a little bit more. If you are 40, 50, 60 years old, you put a bit less. If you are very close to retirement or if you need the money anytime soon, then allocate less to leverage ETFs or don't allocate at all to leverage ETFs. But in my case, because I'm 39 years old, I have 30% of my portfolio invested in leverage ETFs, such as the Triple Q, which is 3x NASDAQ, and UPRO, which is 3x the S&P 500. And personally, I will be fine if leverage ETFs drop by 80% tomorrow, and I will be even finer when they give me a 100x return on investment in 10 years, okay? I'm okay seeing my portfolio dropping 80% because I know I can have a 100x in 10 years. Potentially. No one has a crystal ball. And again, I'm doing this because I don't need this money in the short term. You should only invest in leverage ETFs if you know that you are able to not touch that money for the next few years. That's a very, very important thing. Conclusion. Fortune favors the bold. So let's cut through the noise. Leverage ETFs are either your golden ticket to wealth or your one-way ticket to financial ruin. But I hope that with this video, I gave you a little bit additional insights into leverage ETFs. Leverage ETFs can be a good long-term investing. I did hundreds of back testings. I've been doing this for years, but you need to have discipline and you need to be psychological strong in case you see volatility in the market. If you are one of those people that cannot sleep at night because the stock market is red, then forget, don't invest in this. But if you want to see huge upsides, astronomical upsides, then allocate a little bit of your portfolio into it. I would personally recommend, maybe if you never invested in ETFs, first start to invest in regular S&P 500 ETFs. You have like VOO or SPY for S&P 500 ETFs. You have the QQQ, which is a Nasdaq ETF, like normal, no leverage or 1x leverage. And you can then invest a little bit in leverage ETFs. Can be triple Q, which is 3x as Nasdaq. It can be QLD, which is 2x Nasdaq. You can invest in SSO, which is 2x S&P 500, or UPRO, which is 3x S&P 500. And most brokers, they allow you to invest as little as $50, just to do the experiment, just for you to start to feel comfortable. You can put $100, $50, whatever, and see it working, invest for 1 year with very little money, and then you feel like, oh, this is not that bad, okay? Actually, the returns are quite good. Okay, let's invest a little bit more. So most people will fail because they will panic during market crashes, sell at the bottom, and miss the recovery. The recovery when the market crashes is the most important thing, and you cannot miss it. That's why I never, ever sell if there is a market crash. Of course, I will have money on the side. I have dry powder on the side so that I can buy the dip. I'm never invested 100%. And the market crashes, and I'll be very happy. So I'm happy no matter what the market does. If it goes up, I'm happy because it goes up. If it goes down, I'm happy because now I can finally use my cash to buy the dip, and the market then recovers, and I'm happy. So no matter what, I'm happy. That's a very useful mindset to be a long-term investor. All right, guys, this is how to be a limitless investor. By the way, I have my Be Limitless community on School. I will leave also the link in the description of the video. It's a community of investors where I share everything about AI investing, stock market, crypto, share all my trade alerts. I share a ton of courses. By being a Be Limitless member, you have access to more than 10 courses about crypto, about investing, about ETFs, and many new courses coming up. All right, guys, if you enjoyed this video, give it a like and subscribe so that you don't miss the next one, and I'll see you soon.